Welcome back to the Deep Dive. Today we are cracking open the vault of a European financial giant that, well, spent the last few years systematically undoing its own identity. We are talking about Sampo Oyj, a Finnish group that has executed what you can really only describe as a massive multi-year strategic transformation.
It really is quite something.
They went from this sort of diversified sprawl to laser focus. And our mission today is to deep dive into the source material, really try and understand the mechanics and maybe the mathematics behind this pivot.
Yeah, it's truly a textbook case of strategic simplification, I think, and a great case study for you, the listener, actually.
Definitely.
Sampo went from being this, complex financial conglomerate, major holdings in global banking, market-sensitive life insurance, to becoming, well, a singularly focused pure-play property and casualty, or P&C insurance powerhouse.
And we have stacks of research here on their recent moves, the competitive landscape they pretty much dominate, and their financial targets. We really need to understand the why behind this dramatic shift. What competitive advantages they've kind of cemented in the process, and critically, and this is the big question, I think, why the market assigns this newly simplified business a valuation premium, a significant premium compared to most of its global peers.
That's the multi-billion euro question, isn't it?
Exactly. We're talking quality earnings, and the market is clearly, willing to pay up for it.
And what's fascinating here, I think, is that the transformation is the central theme of the current investment case. It's not just background noise.
Right.
When we say pure play P&C, we mean they focus almost exclusively on general insurance, so motor, home, commercial liability, industrial risk, that kind of thing. The business that, renews annually and is relatively short cycle.
Which is quite different from life insurance.
Totally different. This inherently reduces their exposure to, say, long-term market interest rate risk compared to those legacy life insurance operations or volatile banking assets. The core insight that really drove this whole overhaul, it seems to be the belief that their fundamental core competency, which is superior underwriting, and you see that evidenced by a best-in-class combined ratio, was being sort of hidden or masked by the complexity and, frankly, the lower returns of the conglomerate structure.
So investors couldn't really see the jewel in the crown, clearly?
Pretty much. They simply couldn't value the quality of the core P&C business accurately, and that led to, a significant conglomerate discount. Standard problem.
That makes a lot of sense. Simplification, often the key to unlocking that hidden shareholder value. Okay, let's jump right into the surgical removal process here, because this wasn't just a corporate tweak, was it? This was fundamental reconstruction.
Not at all. It was major surgery.
Okay, let's unpack this transformation. Let's look at the two landmark divestitures that really defined this shift toward pure play P&C.
Right. There were two massive multi-billion euro transactions. First, the systematic multi-year sale of their substantial long-term shareholding in Nordea Bank.
A huge pan-Nordic bank.
Exactly. And this was a strategic decision that began years ago. It wasn't sudden, but they finally completed the full exit in April 2022.
So not a fire sale.
Disciplined.
Very disciplined. A phased process, really, to realize value and, crucially, move entirely away from the risks and, importantly, the capital requirements inherent in the banking sector. Banking is very capital hungry.
Okay, that was number one. And the second part was focused more internally on their own insurance house, right? Shedding the remaining non-P&C assets.
Exactly right. The second defining move was the partial demerger of Mandatum. Now, Mandatum was their life insurance and asset management subsidiary.
Got it.
This was completed pretty recently, October 1st, 2023. Mandatum provided, traditional life insurance products, robust wealth management services, meaning its liabilities and assets were highly sensitive to market movements and especially interest rates.
The long-term interest rate exposure again. Precisely. So the demerger was explicitly designed to make Sampo a 100% focused P&C insurer, just cleanly separating those market-sensitive, capital-intensive life and investment operations from the stable core underwriting business.
So strategically then, why did this wholesale simplification matter so much?
Yeah.
I mean, they essentially forfeited significant revenue streams to gain this focus.
Yeah.
What's the strategic calculus there? It seems quite bold.
Well, it was bold, but the deliberate choice was really a trade-off aimed at two key outcomes. risk reduction, and capital efficiency.
Okay.
By exiting Nordea and demerging Mandatum, they substantially reduce their direct exposure to banking sector risks, which, as we know, can be massive during economic stress.
Absolutely.
And crucially, they reduce that interest rate sensitivity that's just inherent in the life insurance business. P&C liabilities are generally short-term. You pay claims out within a few years, usually. Right. Life insurance liabilities, they stretch decades. That makes them highly sensitive to even small changes in long-term rates. So shorter cycle equals, well, simply risk management. Less guessing about the future.
And the capital consequence must have been huge. I mean, getting rid of that Nordea stake alone must have freed up immense, previously sort of trapped capital.
Immense is definitely the right word. The capital unlocked from these disposals, particularly the Nordea proceeds, was absolutely instrumental in funding what they called a super dividend.
Right, I remember that.
They returned approximately EUR 7 billion to shareholders just between 2021 and 2023.
7 billion euros. That's staggering.
It is staggering, and that figure demonstrated two things very clearly to the market. First, the true scale of the capital that was tied up in those non-core assets, and second, an absolutely ironclad commitment to a shareholder-friendly narrative.
They walked the talk.
They really did. They proved they would divest non-core capital and immediately return it. Not reinvest it in some pet project. Return it.
Okay, that leads us nicely to the structure they've settled on now. Sampo operates as a holding company, right? Overseeing its core subsidiaries. If P&C, which dominates the Nordics, Hastings in the UK, and Topdanmark in Denmark, which, as you said, they are now fully integrating.
That's the setup.
So how does this holding company structure actually create value beyond just, making things simpler on paper? How does it make the whole greater than the sum of its parts?
Well, it creates value primarily through, I'd say, three main mechanisms that leverage their pan-Nordic and UK scale.
Okay.
First, there's efficient capital allocation. Think of the holding structure as kind of an internal, frictionless capital market. The massive, dependable cash flow generated by the mature and highly profitable Nordic operations, that's mainly two. If P&C can be efficiently and strategically moved to fund high growth or maybe high technology initiatives elsewhere, like, for example, the digital investments required to compete effectively in the more dynamic Hastings unit in the UK.
Okay. So the Scalable Nordic engine is essentially sort of subsidizing the technology and maybe the growth risks in the more volatile UK segment. That sounds like a pretty smart way to deploy capital without having to tap external funding markets for every single strategic move.
Precisely. And this centralized efficiency should, in theory, lower their overall weighted average cost of capital. The second mechanism is leveraging scale and synergies.
Right.
By operating as a group under the Sampo umbrella, they can centralize things like back office functions, share best underwriting practices across the different units, and crucially, leverage a single pan-Nordic IT platform. We mentioned earlier they invested, over €1 billion in tech over the last decade?
Yeah, that 1 billion figure really stands out because that's a massive barrier to entry for smaller competitors, isn't it?
It absolutely is. Smaller regional rivals simply cannot afford that kind of sustained, massive technological investment. We're talking AI pricing models, claims, processing automation, digital distribution channels.
Things that require serious scale.
Exactly. Sampo's scale translates directly into efficiency gains that smaller competitors just can't touch. The synergy is really built on that shared IT infrastructure.
Okay, efficient capital, leveraging scale.
Yeah.
What's the third point? You said it speaks to resilience.
That's risk diversification. Even though they shed the banking and life risks, they deliberately retain geographic diversification. By operating across three distinct geographical areas, the stable Nordics, so Sweden, Denmark, Norway, Finland, the smaller Baltic states, and the highly competitive UK, they achieve a level of portfolio diversification that provides resilience.
So if one market has a bad year.
Exactly. If, say, Norway experiences an unusually severe winter with massive claims payouts for burst pipes or whatever, the profits from Sweden and maybe the recovering UK market can smooth out the impact on the group's overall profitability. They aren't betting everything on the weather or economy in just one country.
Makes sense. Diversification within the P&C focus. Right, so to really see this business post-pivot, we need to look at the structure they operate in now. And we should probably note for the listener, Sampo is moving to a new 4-segment reporting structure that's effective from Q1 2025.
That's right. It's important context.
Yeah, it means investors will need to look at restated key figures to make, proper apples-to-apples comparisons going forward. But the goal seems crystal clear. give unparalleled transparency into where that underwriting profit is actually coming from.
Absolutely. Total transparency is the aim. And when we look at that new structure, the first and really the most vital segment is the Nordic engine, private Nordic. This is, the undisputed core of the entire investment thesis.
Okay, give us the scale here. What are we talking about in terms of size and influence in that region?
Well, this segment is massive for them. It represents around 44% of their total estimated insurance revenue for 2024.
Wow, nearly half.
Yeah. It serves approximately 3.7 million households across the four main Nordic countries, primarily via their dominant brands. If, and now fully integrating Top Denmark, If is really the umbrella entity that has successfully built up this formidable presence across multiple Nordic markets over years.
And the market dynamics here are absolutely crucial, aren't they?
Right.
What makes the Nordic P&C market so, well, stable and reliably profitable compared to, say, somewhere like Germany or France or even the UK?
Yeah, it's often described almost as an oligopoly. It's a near-perfect environment for an established player like Sampo.
Right.
It is mature, very stable, and characterized by remarkably high customer retention rates. We're talking typically ranging from 80% to 90%.
80 to 90% retention. That's incredibly sticky.
It is incredibly sticky. Why? Well, customer inertia is strong. People don't switch insurers lightly. And consumers tend to value security and trust over, marginal price differences, especially for important things like home or car insurance. Furthermore, these operations run with very low expense ratios, typically between 15% and 20%. That reflects years of operational efficiency built on that centralized IT spend we just talked about.
Okay, now here's what seems like the real source of their competitive moat.
Yeah.
This extreme market concentration you mentioned.
That's the critical piece of the puzzle, absolutely. The Nordics have inherently high barriers to entry, partly regulatory history, partly the cost of building brand trust over decades.
Okay.
In Sweden, Norway, and Finland, the top four insurers, just four, control a staggering 70% to 90% of the entire market share.
70 to 90%, that's concentrated.
Highly concentrated. And Sampo is the undisputed market leader within that group, holding an approximate 20% share of the total Nordic P&C market as of 2023. That kind of dominance, that scale, it allows them to influence pricing stability and invest far, far ahead of the competition in things like tech.
But hang on, doesn't that extreme market concentration pose a significant regulatory risk? I mean, if you and three others control 90% of a market, surely the government or the competition authority must be watching your every move. How does Sampo justify this dominance without inviting, regulatory investigations into anti-competitive behavior?
That's a really sharp question, and it's definitely a risk they have to manage actively. I think the key difference here often lies in the perceived benefit or lack of detriment to the consumer.
How so?
Well, in these markets, the high concentration means that the few incumbents, particularly Sampo with its scale, can achieve massive operational efficiencies. They argue, and regulators seem to generally accept this, that this scale allows them to offer high-quality, reliable services and, crucially, absorb localized shocks like big weather events better than a more fragmented market could.
So stability is the trade-off for concentration.
Partly. Plus, they consistently invest in things like preventative measures, road safety initiatives, fire prevention advice, which have a public benefit, and their focus isn't necessarily on maximizing short-term profits by squeezing every last cent out of customers. It's more about sustaining stable, predictable underwriting profits over the long term. They aren't, price gouging to the point of obvious consumer detriment, which seems to keep the regulators broadly satisfied, if watchful.
That makes sense. Stability and efficiency is the counter-argument. Okay, let's briefly cover the other Nordic segments that add to this stability picture. Nordic Commercial, that's about 25% of revenue, serving 450,000 SMEs.
Right, small and medium businesses.
And Nordic Industrial, which is smaller, about 8% of revenue, handling maybe 1,200 large corporates. These just sort of diversify the risk within that stable environment.
Exactly. These segments really just confirm the overall, let's say, rational nature of the Nordic market. Whether it's insuring a family car, a small shop, or a major industrial facility like an oil rig, the underlying underwriting discipline and the pricing power remain pretty robust across all these segments. It ensures a consistent profit contribution from the region.
Okay, now let's pivot sharply south, geographically and maybe metaphorically, to the UK challenge. This is segment 2. The private UK segment, operating through the Hastings brand, accounts for a substantial 20% of 2024 revenue, you said.
Yep, about a fifth of the business now.
This market sounds like a complete 180-degree turn from the stability we just described in the Nordics.
It absolutely is. The UK motor market particularly is fiercely competitive, intensely volatile, and highly transactional. Very different beast.
How so?
Well, unlike the Nordics, where brand and relationships matter more, the UK market structure is utterly dominated by price comparison websites, or PCWs.
Aggregators?
Here, compare the market, etc.
Right.
Exactly those. These platforms foster acute price transparency. Consumers can switch insurers in minutes for even the smallest discount, and that puts constant, brutal pressure on underwriting margins. Loyalty is low.
And they've faced some significant industry headwinds recently, too, haven't they? Claims inflation was astronomical for a while.
Yeah, it hit 12% in UK motor in 2023, which is huge. And on top of that, the regulatory landscape changed dramatically in 2022.
Ah, yes, the FCA rule change.
That's the one. The Financial Conduct Authority banned price walking. That was the, let's be honest, pretty dubious practice of offering cheap introductory rates to hook new customers while systematically hiking prices year after year for loyal existing customers.
Loyalty penalty.
Exactly. Banning it required every single insurer to completely recalibrate their pricing algorithms and their marketing spend, basically overnight. It led to massive industry-wide upheaval and significant margin compression for many players.
Okay, so in this absolute cutthroat environment, what is Sampo's counter strategy with Hastings? You mentioned Hastings specializes in non-standard motor insurance policies for drivers with maybe slightly higher risk profiles.
Right. So their competitive edge here isn't scale, like in the Nordics. It's purely technological and analytical sophistication.
Okay.
Hastings is a true digitally native operating model. It grew up with the PCWs. They leverage really cutting-edge, data-driven pricing algorithms and highly sophisticated anti-fraud capabilities built on years and years of proprietary data gleaned from millions of PCW interactions.
They know that channel inside out.
Completely. They compete not on brand loyalty, because there isn't much, but on being smarter and faster at accurately pricing complex, often higher risk policies than their competitors. They aim to be masters of that specific PCW distribution channel for their niche.
That contrast is really vital, isn't it? And it sort of sums up the core tension maybe within the group now. The Nordic operations are the predictable, stable, cash-generating engine, rewarding brand loyalty and massive scale.
The bedrock.
While the UK operations are cyclical, potentially higher growth, but definitely riskier, technologically driven, and rely entirely on analytical discipline to survive, let alone thrive, in brutal price competition.
And that tension, that contrast, is exactly what the holding company structure is designed to manage. Shielding the predictable engine from the volatile growth driver, while allowing the predictable engine to fund the essential technology needed for that growth driver to compete. It's a balancing act.
A necessary one, it seems.
Yeah.
Okay, this brings us neatly to the metric that really validates this entire strategy.
Yeah.
The combined ratio, CR. You mentioned it earlier. It's the investor's North Star in P&C insurance, right?
Right.
And SAMPO's performance here seems to be what justifies, or at least explains, that entire valuation premium we talked about.
It absolutely is fundamental, yeah. Just to quickly reiterate for our listener, the combined ratio is simply the measure of money spent on claims plus expenses relative to the premiums collected. If the CR is below 100%, the insurer is profitable purely on their core insurance activities. The underwriting, completely independent of whatever returns they might make on their investments, their float.
And SAMPO's track record here is, well, quite frankly, phenomenal compared to peers. They reported CR of 84.6% in 2023.
Yep.
Which actually improved slightly to 84.3% in 2024. That comfortably meets their old target of being below 86%. When you look at other big European insurers, many of them struggle to consistently stay below, say, 92% or 93%. Some are even higher.
Yeah, an 84% combined ratio is genuinely exceptional and, frankly, quite challenging to sustain year after year. It means, very simply, that for every 100 euros they collect in premiums, they're only spending 84 euros on claims and running the business.
Leaving 16 euros of pure underwriting profit.
Exactly. That 16 euro difference is underwriting profit. And their new ambition really speaks volumes about their confidence in the structural integrity of the simplified business. They've set a new, tougher target for the 2024-2026 strategic period. They're aiming to maintain an annual group CR below 85%.
So embedding that excellence, not just a one-off.
That's the goal. And the private Nordic segment, as you'd expect, consistently pulls that group average down, showing where the real bedrock strength lies.
What was the Nordic figure again?
Private Nordic delivered a very strong 81.7% CR in Q2 2025, for example.
Wow, 81.7.
Yeah. This just underscores the structural stability and the efficiency of that core market we discussed. Now, Hastings CR in the UK will naturally be higher because of the volatility and competition there,
Sure.
but it's Sampo's ability to consistently anchor the whole group's ratio in the mid-80s that really defines its quality in the eyes of investors.
Okay. Now, let's address the historical financial context quickly because it's important. If you just look at their headline revenue over the last 5 or 10 years on a chart, it actually shows a decline.
Which could be confusing, right? To a new analyst looking at the company? That's where understanding the strategy is absolutely vital. That decline you see is purely an artifact of the strategy itself. It directly reflects the divestments of Nordea and Mandatum. Huge chunks of revenue removed.
Right.
It is not a reflection of any weakness in the underlying core P&C business. That's crucial. When we strip out those divested assets, the remaining P&C engine actually shows robust, high-quality growth.
Okay, so what are the P&C growth numbers telling us about the health of that core business then?
Well, if we look at the core P&C growth, gross written premiums, GWP, that's the total premiums written before deductions grew consistently, from about $8.87 billion in 2023 to $9.93 billion in 2024.
Okay, solid top-line growth.
Solid top line, yes. But arguably more important than just top line premium growth is what they actually kept as profit, the core underwriting profit. That grew by a strong 13% between 2023, when it was $1.164 billion, and 2024, hitting $1.316 billion.
13% growth in underwriting profit. That's strong.
Very strong. And it shows they're growing premiums while simultaneously maintaining that strict pricing discipline. That's essential to keeping that combined ratio low. Profitable growth, not just growth for growth's sake.
Right, so they aren't just, buying market share by cutting prices recklessly. They're gaining share, presumably, by being more efficient and pricing risks more accurately than competitors.
That's the strategy in a nutshell.
So what are the key organic growth drivers underpinning this performance? Where's the growth coming from internally?
Well, technology is definitely the first driver. They are clearly seeing tangible returns on that huge IT investment we keep mentioning. Digital momentum is accelerating.
How so?
Digital sales in the crucial private Nordic segment grew 10% in 2024, and that actually accelerated to 12% in the first half of 2025.
12% digital growth in a mature market.
Yeah. And furthermore, in the historically slower-moving Nordic commercial segment, ensuring SMEs' fully online digital sales surged by an amazing 30% in the first half of 2025.
30%. Wow. That's huge for commercial insurance, which is traditionally very reliant on brokers and face-to-face interaction.
It really is. It speaks to a successful shift in consumer and, importantly, small business behavior being effectively captured by Sampo's updated digital platforms. They're making it easy.
Okay, so digital is one driver. What else?
They are also successfully pushing into specific high-growth product areas, particularly personal insurance lines like health and accident coverage.
Right.
This segment grew 11% in 2024, really capitalizing on rising demand for private healthcare solutions across the Nordics, where public systems might be under strain.
Makes sense.
And despite all the volatility we talked about, the UK segment is still a growth engine too, remember. Hastings added over 400,000 new policies in 2024.
400,000.
Yeah, and has basically doubled its total premiums since Sampo acquired it back in 2020. So that showcases pretty impressive market penetration, even in a tough environment. They're taking share.
Okay. Finally, on this growth and structure point, let's look at the remaining M&A focus. The massive top-down integration. This feels like the final major piece of the initial simplification consolidation puzzle, doesn't it? Getting that fully folded in.
It absolutely is the defining M&A action of this new pure-play era. Sampo launched an exchange offer back in June 2024 aimed at securing 100% ownership of Top Denmark, moving from a controlling stake to full ownership,
Right.
and achieving full integration. The legal merger itself was finalized in July 2025. Management has been very clear that they expect the accelerated realization of synergies, meaning cost savings, IT efficiencies, operational overlaps removed, to start hitting the P&L significantly in the second half of 2025.
What kind of synergies are we talking about? What's involved?
Well, we are talking about integrating two massive, complex IT systems, Eva's platform and Top Danmark's, merging operational centers, call centers, claims handling departments, optimizing reinsurance structures across the larger combined entity. It's complex, no doubt about it, but the prize in terms of cost savings is potentially substantial.
Does this integration face any specific political or regulatory pushback in Denmark? I mean, given that it concentrates an already highly concentrated market even further, adding Top Denmark fully into the Sampo fold?
It was certainly scrutinized by the Danish regulators, yes, but I think the fact that Sampo already owned a large controlling stake in Top Denmark for so long helped.
Yeah.
And the fact that the Danish market, while concentrated, still sees effective competition from a few other major players, like Tryg and Alm brand.
Okay.
The key for regulators, again, seems to be demonstrating that the merger generates genuine efficiencies like lower operating costs through IT integration that can potentially benefit consumers through stable, competitive pricing in the long run, rather than simply reducing choices or enabling price hikes. The focus is on synergy realization, not necessarily market power abuse.
Got it. So looking ahead then, what is the post-Top Denmark M&A philosophy? Given their huge scale now, especially in the Nordics, they must always be scanning the horizon for the next large-scale acquisition, surely.
Actually, their stated philosophy is explicitly disciplined.
Yeah.
Very much so.
Meaning?
Management maintains they are limited primarily to bolt-on acquisitions, smaller deals, basically, in existing markets or adjacent niches. Something like the acquisition of Una Health in 2023, which expanded their health insurance footprint slightly.
So no big transformational deals planned.
They are explicitly avoiding large-scale M&A right now. Management cites two key hurdles consistently. First, current high valuations across the insurance industry generally make big deals look expensive. And second, critically, potential regulatory hurdles from competition authorities, especially in that now even more consolidated Nordic market.
So too big to buy big, maybe.
Effectively, yeah. They're signaling pretty clearly our best strategic move now is internal optimization, finishing the Top Denmark integration smoothly and returning excess capital, not expensive, risky empire building through major M&A. #V, capital allocation and shareholder returns.
Okay, this brings us to a major, and you could argue, non-negotiable component of the investment thesis for Sampo. Its explicit shareholder-centric philosophy. This policy, this approach, really seems to differentiate it from many other large European financial institutions, who often tend to hoard capital, right?
It really does stand out. They have a very clear, very predictable, dual-pronged policy for capital allocation.
Okay, what's prong one?
Prong one is the regular dividend. This is committed to being stable, sustainable, and ideally growing over time. Critically, they provide a strong floor for expectations. They commit to distributing at least 70% of operating profits annually as a regular dividend.
At least 70%. That's a high payout ratio.
It's very high, and it provides a strong sense of reliability and income certainty for investors. It also signals management's confidence that future profits will remain strong enough to support it.
Okay, high regular payout. What about the second prong, which seems particularly relevant given their unique position post-divestiture with all that freed-up capital?
That is the excess capital return policy. Basically, any capital the company deems surplus to its internal operating needs and its regulatory solvency requirements is returned to shareholders promptly.
How do they return it?
It's executed either through supplemental special dividends, one-off payments on top of the regular one, or, increasingly, through large-scale share buyback programs.
And we really cannot stress enough the proof of execution on this front, can we? The scale of the returns have been just immense recently. Remind the listener that figure again.
Yeah, it bears repeating. They returned approximately 7 billion euros to shareholders just between 2021 and 2023 alone.
Wow.
Most of that was funded, as we said, by the Nordea divestment proceeds. But still, that is an astonishing amount of capital for a European company of this size to return in such a short period.
And what message did that send?
It sent a profound, absolutely unmistakable message to the market. This management team is deadly serious about capital efficiency and deep alignment with shareholder interests. They are not empire builders hoarding cash. They are capital managers focused on returns.
And we see that policy continuing right now, don't we?
Absolutely. They announced a new 200 million share buyback program just in August 2025. And they've proposed a regular dividend of 1.70 per share for the 2024 fiscal year. The commitment is ongoing.
And this commitment is supported, presumably, by their improved capital efficiency goals. They've tweaked their targets there, too.
Yes, exactly. Since they became this focused, pure-play P&C insurer, the group's overall risk profile has fundamentally changed. It's lower risk now without banking and life insurance, and that allowed them to optimize their regulatory capital targets.
How so?
They successfully argued for and received approval for lowering their target solvency through a ratio range. It used to be 170% to 190% of required capital. Now the target range is lower, down to 150% 50% to 190%.
Okay, why does lowering that target range matter for the average shareholder? What does that actually mean in practice?
Well, it matters quite a bit. Regulatory capital, that solvency theory ratio, is essentially the safety buffer of capital regulators require the company to hold just in case things go badly wrong.
Right, the rainy day fund.
Exactly. By successfully simplifying the business, shedding the market risk of banking, and the long-term interest rate risk of life insurance, the company now demonstrably requires a smaller safety buffer to be considered safe by regulators.
Okay.
This means that less capital needs to be held trapped in these low-yielding regulatory reserves on the balance sheet, and that frees up more cash flow for either shareholder returns or maybe those bolt-on growth initiatives. It makes the balance sheet more efficient.
And where are they currently within that new range?
Their current ratio stands comfortably within the new range, reported at 174%, so well above the minimum 150% floor, but below the 190% ceiling, indicating they aren't holding excessive capital unnecessarily. It confirms that reduced market risk profile is real.
And looking forward, they've set an incredibly ambitious financial target for generating capital to deploy for these purposes, haven't they?
They have. It's quite punchy. They are targeting generating more than $4 billion of deployable capital just during the 3-year strategic period from 2024 to 2026.
4 billion euros. Where does that come from?
It's expected to be sourced from a combination of accumulated operating profits from the insurance business, combined with ongoing optimization of their technical reserves, how they provision for future claims, and also careful management of their reinsurance structures.
Okay.
This isn't just, theoretical blue sky thinking. It's presented as a firm financial commitment to generating enough internal cash flow and optimizing the balance sheet sufficiently to guarantee significant future shareholder returns over the next few years, whether that's through dividends or buybacks, or perhaps funding a few more disciplined bolt-on deals if the right opportunities arise. Hashtag CSAX, navigating headwinds and justifying the premium valuation.
Okay, so while the big strategic pivot is complete, Sampo still operates within a pretty dynamic macro environment. Let's talk about the role of interest rates first. They've shifted significantly globally in the last couple of years. Rising rates are generally viewed as a net positive for P&C insurers, correct?
Yes, generally speaking, they are a very significant tailwind for P&C insurers like Sampo.
Why is that?
Well, a P&C insurer holds this vast investment portfolio, sometimes called the float, which is basically premiums collected but not yet paid out as claims. They hold this float to back their usually short-term insurance liabilities.
Right.
This float is primarily invested in highly safe, relatively short-duration fixed income assets, bonds, essentially. As the overall interest rate environment has climbed significantly, those existing bonds mature, and the cash is reinvested into new bonds at much higher yields.
More income from the investments.
Exactly. This is leading to a durable, structural, and increased stream of net investment income flowing through to their bottom line. It provides a structural lift to their overall profitability that should compound over time as more of the portfolio rolls over at higher rates. It's a nice tailwind.
But this shift, while economically beneficial for them in the long run, has apparently created some confusing short-term volatility in the reported numbers. That's due to new accounting standards, IFRS 17. We should probably touch on that technical detail, shouldn't we?
Yeah, it's a slightly nuanced point, but important for any listener tracking European insurers right now. Under the new IFRS 17 accounting rules, when market interest rates rise, the discount rate that insurers must apply to estimate the present value of their future insurance liabilities also rises.
Yeah.
Using a higher discount rate effectively reduces the calculated present value of those long-term liabilities on the balance sheet today. And that change in liability value creates an immediate non-cash accounting impact, often a negative one on the reported profit in the short term, paradoxically. It can make the profits look temporarily volatile or even suppressed on paper.
Okay, wait, so the underlying economic reality is fantastic. They're actually earning more money on their float.
Correct. More cash coming in.
But the accounting reality, because of IFRS 17, can look choppy or even negative in a quarter, just because of how they had to discount future liabilities based on current rates.
Precisely. It's counterintuitive. The real economic benefit of higher returning investment income is the major long-term driver of value creation. But you absolutely have to look past the short-term IFRS 17 accounting noise, which is merely a technical reflection of the rate change itself, not a fundamental change in the underlying quality or profitability of the underwriting business.
Okay, important distinction there. Let's discuss the other major headwind they faced. Claims inflation. This has been a persistent global issue, hasn't it? Particularly in motor insurance.
It certainly has been persistent, yeah. Especially as we noted in the UK motor market, where it hit that peak of 12% back in 2023. That was driven by rising labor costs for car repairs, lingering parts shortages post-pandemic, and also the increasing complexity of modern cars making repairs more expensive.
So how has Sampo managed this? Have they just absorbed the cost?
No, they haven't just absorbed it. That would kill their combined ratio. They have successfully managed this primarily through highly disciplined, proactive pricing actions, taking price increases to offset the rising claims costs. Well, for example, in the Norwegian market, where If is dominant, they implemented premium price increases averaging approximately 10% year-to-date in 2025. That was well ahead of the estimated claims inflation rate there, which was running around 5%.
They stayed ahead of the curve.
Exactly. They are proactive, not reactive, in their pricing adjustments where market conditions allow. The really critical positive update now, though, is that management is reporting that claims inflation is generally fading across the Nordics and definitely moderating in the UK from those peaks. That's a major positive for protecting those crucial underwriting margins going forward.
Okay, good news on the inflation front then.
Yeah.
We also have a major change in leadership to discuss, which perhaps ironically seems to signal massive continuity rather than change.
Indeed. Torbjørn Magnusson, who is really the architect of this entire transformation strategy over the past few years, is stepping down as CEO. And Morten Thorsrud is set to succeed him on October 1st, 2025.
Okay, and the significance of Thorsrud.
The really important detail here is that Mr. Thorsrud is currently the CEO of If P&C, which is Sampo's largest, most profitable, and most stable subsidiary, the Nordic engine.
Ah, that is probably the strongest possible signal you could send that the pure play focus, the operational discipline, will continue without any deviation, isn't it? They're literally placing the head of their core underwriting engine in charge of the entire holding group.
Absolutely. It confirms that the strategic direction is set. The future is defined by operational excellence and continued underwriting discipline, focusing on executing the current strategy, not by, say, financial engineering or embarking on a new wave of M&A. They've appointed a proven operator who knows exactly how to generate that target 84-85% combined ratio. Continuity is the message.
Okay. Now, we arrive at the core question of this entire deep dive, really, the valuation discussion. As we record this, say, mid-2025, Sampo trades at a significant premium to its peers. You look at the price-to-earnings ratio, it's roughly 22 times forward earnings, maybe, versus a peer average closer to 14 times.
Yeah, quite a gap.
And the price-to-book ratio is also elevated, around 3.8 times, maybe higher. If you just look at those headline multiples in isolation, the stock looks expensive, doesn't it?
On the surface, yes, definitely expensive compared to the sector average.
So what are the core justifications? Can we boil it down? Why is the market paying so much more for Sampo than for its direct competitors like Allianz or Zurich or AXA, at least on these metrics?
I think the justification really boils down to three interconnected themes: quality, consistency, and alignment.
Okay, let's take those one by one. First, quality.
Superior earnings quality.
Yeah.
Their consistent delivery of a combined ratio in the low to mid-80s year after year means their profits are overwhelmingly derived from durable, fundamental underwriting activities, not from volatile financial trading or unpredictable swings in investment income. This consistency makes their earnings stream highly predictable and therefore perceived as higher quality and more trustworthy by investors.
Okay, quality and predictability. Second,
The clear focus. The massive and, importantly, successfully executed shift to a simplified pure-play P&C model has fundamentally de-risked the overall business profile. Investors generally hate complexity and opacity. By eliminating that conglomerate discount we talked about, the investment case for Sampo is now far clearer, far easier to analyze and trust. And that clarity, that reduced complexity risk, absolutely warrants a higher valuation multiple in the market's eyes.
simplicity premium.
That's
Makes
it.
sense. And third,
And third, the overwhelming demonstrated shareholder alignment. That explicit commitment to returning at least 70% of operating profits as a dividend, coupled with the truly massive scale of share buybacks we discussed, $7 billion, acts as a continuous structural support mechanism for the stock price. The market genuinely believes this management team treats retained capital as temporary, something to be returned if not efficiently deployed, not as permanent capital to build empires. That alignment is highly valued.
quality, focus, alignment. Okay, given all this positivity, we absolutely must outline the core risks to monitor that could potentially threaten this premium valuation down the line. What should investors be watching?
Yeah, absolutely crucial. The risks are perhaps more concentrated now that the business is simplified. On the operational risk side, the P&C insurer is still fundamentally exposed to potentially catastrophic weather events, and that's arguably a risk growing year on year due to climate change.
Right.
Think major floods, windstorms across the Nordics or UK.
Right.
And they're also exposed to renewed spikes in claims inflation, even if it's moderating now. Their underwriting discipline can manage typical volatility, but a true black swan weather event or a sudden unexpected regulatory shock forcing changes to pricing or reserving could certainly test their profitability and reserves.
Okay, operational risks. Then there's this strategic risk that is directly caused by the successful pivot toward focus itself.
Yes, exactly. It's the flip side of the simplification coin, concentration risk. By deliberately jettisoning the non-core banking and life assets, the group is now much more heavily reliant on the competitive dynamics and the overall economic health of just two core regions, the Nordic countries and the UK motor market.
So less diversification benefit than before.
Less broad diversification, yes. A severe, prolonged, localized recession specifically hitting Northern Europe, for instance, would likely impact Sampo's revenue and profits much harder today than it would have done when they still had the diversified earnings stream from Nordea Bank operating across multiple economies.
Okay, concentration risk. And finally, the large execution risk associated with the complexity of major merger activities.
Yes, the Top-Denmark integration is extremely complex operationally. It's a huge undertaking.
Yeah.
Any failure to achieve the projected cost savings and the crucial IT system synergies on time and on budget, or any unforeseen operational disruptions during the merger process, things like integrating customer data smoothly, retaining key personnel, maintaining business continuity without service, drops any slips there could negatively impact the group's profitability quite quickly. And that profitability is what justifies that high valuation. The market is essentially pricing in perfect, seamless execution of this huge integration project right now. Any stumbles could be punished. #7. Conclusion and final thought.
Okay, so let's try and summarize the current identity for the listener, pulling all these threads together. Sampo has successfully navigated this huge transformation, moved from being a sprawling, somewhat opaque conglomerate to becoming a lean, market-leading, demonstrably high-quality, pure-play P&C insurer. They have a clear and, importantly, an executed strategy. They have genuinely superior profitability driven by that relentless underwriting discipline. The crucial 84-something% combined ratio is key.
Absolutely central.
And they have a management team that is very strongly aligned with shareholder interests, which they've proven conclusively with that immense scale of capital returns, the buybacks, the high dividend payout.
I think the aha moment for many analysts looking at Sampo is understanding just how capital light this focused operational model truly is now.
What do you mean by capital light?
Well, they only need to spend about 7.5%, maybe slightly less, of their cash flow from operations on actual capital expenditures, CapEx. And most of that is just ongoing IT development and maintenance to sustain the business. It's not like a manufacturer needing huge factories. Furthermore, their competitive moat, especially in the Nordics, rests heavily on intangible assets. Things like the strong brand equity of if, deep, long-standing customer relationships built over decades, vast amounts of proprietary data for pricing analytics, and those robust, efficient digital platforms we discussed. These things are incredibly valuable but often don't show up fully or are undervalued on a traditional balance sheet compared to their true market value. This underlying structural quality is really what commands that premium price in the market.
It is a phenomenal story of focus and execution, no doubt. But that brings us inevitably to the final, perhaps provocative question for you, the listener, to consider as you go through your own analysis of this material based on our deep dive today. The current valuation, that high PE, that high price to book, clearly prices in a significant degree of continued operational perfection. The multiple is stretching well above historical norms and current peer averages. So the big question is, can any insurance company, even one as strong as Sampo, with a 20% market share and an 84% combined ratio, truly escape the inherent cyclicality and volatility of the fundamental property and casualty industry, be it from climate change driving more severe weather, or unexpected regulatory shifts, or just intense competitive pricing cycles? Can they sustain a permanent structural valuation premium over their global peers indefinitely?
Yeah, it's the classic stability versus valuation debate, isn't it? They seem to have perfected the formula for generating high-quality, stable earnings today. The challenge, the thing investors need to watch constantly, is whether that underlying quality, that 84% CR, can withstand the next inevitable external storm, whether that storm is meteorological, like a hurricane season, or economic, like a deep recession, or regulatory, like a sudden government intervention in pricing.
Hmm.
Can they withstand that without the market demanding a swift reversal of some or all of that hard-earned valuation premium?
Right.
The pressure on management to maintain operational perfection, to keep delivering that low 80 CR quarter after quarter, is now immense precisely because of that high valuation. There's very little room for error priced in.
Food for thought indeed. A high-quality problem, perhaps, but a challenge nonetheless. Thank you for joining us on this deep dive.